We are looking at a number that is genuinely difficult for the human mind to wrap around. $5.4 trillion. To give you a sense of the scale, that is roughly the entire GDP of Japan. It is more than the value of the London Stock Exchange. And right now, all that value is trapped. Financial analysts call this a liquidity overhang. It's a polite, antiseptic term for a massive structural problem. Over 1,300 unicorns, startups valued over $1 billion, are stuck in the private markets. They are like planes circling an airport, running low on fuel, waiting for a runway that hasn't been opened for years. But the data suggests the dam is finally about to break. This is being forecast as the year of the Titans. By the end of this video, we aren't just going to tell you who is going public. We are going to deploy a theoretical $100 bankroll to find the alpha, the exact spot where the market is wrong and where the profit is hidden. But first, you need to understand that narratives are expensive. If you buy the story everyone else is telling, you are paying a premium for it. To find an edge, we need to have stripped away the dinner party conversation and step into the trading floor. We need to know why a CEO saying accurate might be a trap and why a baby food company is safer than a rocket ship. And we need to talk about the corporate espionage lawsuit that is almost no one is paying attention to. We have been living through a nuclear winter for IPOs. High interest rates, geopolitical chaos kept the exit doors welded shut. Venture capital funds from 2014 and 2015 are legally mandated to return cash to their investors. They literally cannot wait anymore. It's not just that these companies want to go public. It's that the pressure inside is becoming dangerous. Employees are holding stock options that are expiring worthless. The 2026 super cycle isn't a party, it's a pressure release valve. To analyze this, we are using a forecasting framework called the Council of Rivals. Instead of one guru's gut feeling, we synthesized 5 conflicting analytical lenses. The historian looks at the base rates. The news hound hunts for leaks. The firmizer checks the math. And the pre-mortem analyst assumes the IPO has already failed and asks the question, why? It sounds dramatic, like a secret society meeting in a basement, doesn't it? But this is how you avoid the so-called guru trap. We ran 7 major companies through an automated super forecasting agent called the Elite Predictor 2. We aren't looking for yes or no. We are looking for the gap between the market price and reality. Let's start with the Titan, SpaceX. The prediction markets, specifically Polymarket, are pricing a SpaceX IPO before 2027 at roughly 70 cents. That implies a 70% probability. The newshound lens lights up here. When a report dropped about a 2026 IPO, Elon Musk, who usually trolls or speaks in riddles, replied a single word: accurate. We also have leaks that CFO Brett Johnson sent a memo explicitly mentioning IPO prep. The signals are flashing green. But the pre-mortem lens forced us to invert the timeline. It is December 2026. The IPO didn't happen. Why? 2 words: Starship risk. The entire $500 billion valuation is predicated on the Mars rocket working. If the engineering wobbles, the IPO waits. The council's model puts the probability at 68 to 69%. The market is at 70%. When the model matches the market, the strategy is simply pass. There is no edge here. The market knows what we know. So, no money to be made on Musk. But what if I told you the market is completely misreading the AI war? Investors are desperate for pure play AI exposure. Right now, you have to buy proxies like Nvidia or Microsoft. The market wants the direct line. The market has Anthropic at a coin flip, 53%. But our council is bearish, placing it between 40 and 50%. Yes, they hired the top IPO law firm, Wilson Sonsini. That's a huge signal. They want to be the Cisco to OpenAI's Netscape, the safe, reliable B2B option. But here is the Firmizer trap. Anthropic is raising massive private rounds, potentially $25 billion. If you can raise that much privately without the headache of regulations or short sellers, why go public? The stay private longer strategy is in full effect. If you were a CEO, would you choose endless paperwork or a $25 billion check with no strings attached? Pause and decide. And OpenAI, the market is even more skeptical at 29%. The council agrees. Sam Altman is on record saying he is 0% excited to be a public CEO. Plus, unwinding their chaotic non-profit governance structure is a nightmare. So, we found our first edge. We are betting no on Anthropic. We are fading the hype. Now we move to the traps. This is where the crowd sees a famous name and assumes IPO. But the structural reality screams stop. Databricks seems obvious. 4.8 billion in revenue. Market says 60% chance. Our model says 35%. The CEO explicitly said, I wouldn't bet on it. And they just raised a Series L round. Series L. That buys them 24 months of runway. They don't need the cash. But here is the one that shocked us. The HR platform Deel. The market sees 1 billion in revenue and thinks it's a slam dunk. What if I told you their biggest competitor was accusing them of something straight out of a spy novel? This is the corporate espionage trap we teased at the start. Rippling has sued Deel, alleging they planted an employee inside the company to steal trade secrets. This triggers the SEC's Clean Hands Doctrine. You cannot file for an IPO with an active litigation alleging you built your business on stolen IP. It turns the filing process into a legal nightmare. Combine that with a valuation crunch. Deel was valued at 21 times revenue. Public markets are paying 6 to 8 times. An IPO now would be a massive down round. The market is pricing Deel at 68%. Our counsel gives it 15% for early 2026. This is a massive actionable edge. We are betting heavily on no. We've looked at rockets, AI, and spies, but the safest bet on the board is baby food. Once upon a farm, the market really likes it. The council loves it. It's boring. The S1 is filed. They have an 11-bank syndicate led by Goldman Sachs. When you have 11 banks lined up, the train has left the station. Boring is, in fact, beautiful in capital markets. We lock in the win here. So, here is the final strategy for our $100. We are using the Kelly criteria to size our bets. $0 on SpaceX and Cerberus. Don't fight the efficient market. $2 to $5 on Anthropic, no. $6 to $10 on Databricks, no. $7 on Deel, no. Our highest conviction play against the espionage risk. And $10 on Once Upon a Farm, yes. We keep 70% of the bankroll in reserve, dry powder, because in a super cycle, information changes fast. The historian leaves us with one final sobering provocation. With companies raising $350 billion privately, the era of the IPO might be ending. The public market could become a place for leftovers companies that only go public because they have to, not because they want to. The 2026 year of the Titans might actually be the last great harvest before the game changes forever. If you had $100, would you bet on the rocket or against the spies? Let us know your allocation in the comments and subscribe to see if our bankroll survives 2026.